Welcome to the Deep Dive. Today, we're digging into Wayfair's second quarter 2025 earnings call. And this was a call that definitely gave us a lot to talk about, some really standout moments.
Yeah, definitely some eye-opening highlights, you could say. Gave a much clearer picture of where things stand.
Okay, so let's jump right into the numbers then, because this quarter, Wayfair really, they beat expectations pretty much across the board.
They really did. I mean, starting with GAAP EPS, that's earnings per share under standard accounting, they posted positive 0.11 cents.
Right, and the consensus was actually predicting a loss, so that's a huge beat.
A dramatic beat, yeah. And then the adjusted non-GAAP EPS, which, strips out some of those one-off items to give a clearer view of the core business.
Sure, that come in at?
A massive 0.87 cents. That was more than double what analysts were projecting.
Wow, okay. So, strong bottom line. How about the top line?
Also solid. Revenue grew 5% year over year. That also surpassed the forecasts out there.
And I saw gross margin expanded too.
It did, significantly, hit over 30%. That's a really meaningful improvement, points to better efficiency, maybe some pricing power.
Okay, and that profitability, it seems like it flowed down adjusted EBITDA.
Yep, $205 million. That's actually their highest level for adjusted EBITDA since way back in 2021. Shows some real leverage building in their model.
Leverage meaning as sales go up, profits go up even faster.
Exactly. More of each sales dollar is dropping to the bottom line.
Got it. And maybe the biggest number for investors, free cash flow.
Ah, yes. Very strong. $230 million in free cash flow.
Which, just to remind everyone, is kind of the cash left over after all the bills and investments, right? What they can actually use.
Precisely. And this was driven by good operating cash flow, some working capital benefits too. It marked their best cash generation since Q3 2020.
Okay, so it's no surprise the market reacted positively then.
Not at all. Shares got a pretty significant lift right after the announcement. The numbers really told a story.
So, okay, those are the headlines. Fantastic story. But let's unpack this a bit. How did they actually achieve this? You mentioned the 5% revenue growth.
Right. And interestingly, management pointed out that if you exclude the impact of them exiting Germany.
Right. They pulled out of Germany.
Yeah. Excluding that, the growth would actually have been stronger, around 6%.
So the core business, the remaining footprint, is performing even better than that headline 5% suggests.
Exactly. And management's language was key here. They called it accelerating sales and share gain in tandem with expanding profitability.
Okay, in tandem. So growth and profit margin expansion together.
Which signals that pivot we were talking about. They spent a few years, focusing on recovery, cost cuts.
Right, getting lean.
Now they're saying, okay, we've done that. Now it's about profitable expansion.
Yeah.
And that adjusted EBITDA margin, 6.3% overall, but even better, 7.8% in the U.S.
7.8% in the U.S. Wow.
That really demonstrates the leverage. It shows the model is working efficiently, especially domestically.
And that $230 million in free cash flow you mentioned, how does that change things for them strategically?
It's pretty transformative, I'd say. Connects to their overall financial health. Their liquidity now stands at $1.8 billion.
Okay, so they have cash on hand.
And they're using it. They've been really proactive managing their debt. They used $200 million cash to retire notes that were due in 2025.
Getting ahead of it.
And also paid off nearly all of their 2026 notes. So what that does is it sets up a really clean balance sheet.
Yeah.
No major debt maturities now until September 2027.
That's a long runway.
It is. And management explicitly said this lets them shift to playing offense instead of defense for really the first time in about 3 years.
Playing offense meaning investing more aggressively.
Investing in growth, yeah. Whether it's tech, logistics, maybe even M&A down the line, they have the cash and the confidence now. It's a big statement.
Definitely a significant shift. Okay, let's talk about how management sees this playing out. CEO Niraj Shah talked about these results being just the beginning. And he pointed to 3 pillars. First one was improving the core recipe.
Right, which sounds like focusing on the fundamentals: price, selection, availability, delivery speed.
How critical is that? Just nailing the basics.
Well, it's absolutely foundational. That's table stakes in e-commerce, especially for home goods. Get that wrong and nothing else matters. It drives satisfaction, repeat business, market share.
Okay, so pillar 1 is the foundation. Pillar 2 was leveraging technology.
Yeah. And this is where it gets interesting. They have a huge tech team, like 2,500 people.
Wow.
And they've apparently finished a lot of the big replatforming work, kind of rebuilding the engine.
So now they can build new stuff on top.
Exactly. They're heavily focused now on new features, things like using Gen AI for better search results, product descriptions, even imagery.
AI impacting the shopping experience directly.
And they teased some things for the holidays this year, visual search,
Yeah.
AR room planning tools,
AR room planning, like see the couch in your actual living room on your phone.
something like that, yeah.
Mhm.
And for a category like home goods, which can be complex, difficult to visualize,
Totally.
features like visual search or AR aren't just gimmicks. They could genuinely make it easier to shop and give Wayfair an edge.
Makes sense. Okay, and the third pillar was launching new programs. What falls under that?
A couple of key initiatives here. One is Wayfair Verified. It's a curation program. They actually hand inspect certain key items.
Does that actually move the needle? Hand inspecting.
Apparently, yes. They said it's driving over 25% better conversion rates.
25%?
Yeah, and 20% higher net promoter scores. That's a loyalty metric plus more repeat buys. So it seems that quality signal matters.
Interesting. What else in new programs?
Wayfair Rewards. That's their paid loyalty program.
Like Amazon Prime, but for Wayfair.
Kind of, yeah. And it's apparently gaining traction, beating their expectations on member growth and customer lifetime value.
And does it drive traffic?
Significantly, they said. Especially direct traffic to the site and, importantly, the app. App installs are the highest since late 2020.
And app revenue.
Hit an all-time high. About 30% of their U.S. revenue now comes through the app.
30% is huge. That's a major channel shift.
It really is. Shows customers are engaging more deeply, likely driven partly by that loyalty program.
Okay, and still under new programs, there's physical retail. They opened that first big store.
Yeah.
How's that doing after a year?
Pretty well, according to them. Good response inside the store itself, but also what they call a significant sales halo in the surrounding metro area.
Explain sales halo. Does the store just make people think about Wayfair more?
Essentially, yes. It acts like a big advertisement, boosting brand awareness and, crucially, online sales in that specific region.
Gotcha. So people see the store, maybe visit, maybe not, but then they go online and buy.
Exactly. They gave examples: kitchen accessory sales up over 50% in that metro area, home improvement up over 35%. It lists a whole market for them locally.
So more stores are coming.
It's like it. Atlanta in 2026, New York in 2027, Denver also late 2026. Plus some new stores for their Perigold brand, too.
So they're definitely committed to that omni-channel click-and-mortar approach.
Seems so. Recognizing that even for an online giant, having some physical presence can be valuable.
Okay, this ties into their logistics, right? Because physical stores need inventory, but their core challenge has always been shipping bulky stuff. Let's talk Castlegate.
Yeah, Castlegate is their proprietary logistics network. It's designed specifically for those difficult items: fragile, heavy, bulky furniture, and home goods.
And that's a competitive advantage because shipping that stuff is hard and expensive.
Hugely expensive and complex, yeah. Having their own network tailored to it is a major differentiator.
So what are the components of Castlegate?
Well, there's Castlegate Forwarding, which helps their suppliers get goods efficiently, like using cost-effective ocean freight. Volume there is up 40% year over year.
Okay, helping suppliers get products to Wayfair.
Right. Then there's Castlegate Fulfillment. This is where Wayfair actually holds and ships the inventory themselves. Penetration here is up significantly, 400 basis points year over year.
4 percentage points increase?
Yeah, so now it covers about 25% of their total revenue. And when they fulfill it themselves,
They can control the experience better.
speed.
Exactly. Better speed badging, meaning more items show faster delivery times, lower costs for them, and higher customer satisfaction. It's a win-win-win.
Okay, but the really big news seemed to be the expansion of Castlegate, the 3PL service.
Ah, yes. The multi-channel 3PL expansion. This is a potential game changer.
So they're not just using Castlegate for Wayfair orders anymore.
No. They're now offering it as a service, a third-party logistics service, for their suppliers to fulfill orders that are placed outside of Wayfair, on other websites or maybe the supplier's own site.
So Wayfair is becoming a logistics company for other people selling bulky goods.
That's the idea. They call it their pick and ship service, and they said it's scaling rapidly. Hundreds of suppliers are already using it. Wow, so that creates a whole new revenue stream for them.
An additional and likely accretive revenue stream, meaning it should add nicely to their overall profitability because they're leveraging assets they already have.
Plus, more volume running through their network should make the whole thing more efficient, right?
Precisely. Better utilization, lower unit costs. It's a smart way to monetize that big investment in logistics.
And this focus on efficiency, it seems to show up in their P&L flow-through. The CFO talked about driving owners' earnings.
Yeah, basically meaning maximizing the cash profit that truly belongs to the owners, the shareholders, optimizing how revenue flows down to actual profit.
How are they doing that on the cost side?
Well, customer service and merchant fees were pretty steady at 3.6% of revenue, but advertising costs actually dropped sequentially, down to 11.4% of revenue.
Advertising down. Usually growth requires more ad spend.
Well, they framed it as smarter spending, rigorous ROI measurement, and they mentioned that investments in newer channels like TikTok and Instagram are starting to pay off now.
So getting more bang for their buck on ads.
Seems like it. And that results in what they call their flow-through rate, which is basically gross margin minus those variable costs like customer service and advertising hitting 15.2%.
Just their best.
Since 2023, yeah. Shows that the core profitability of each sale is improving.
And what about their fixed costs? The overhead, SOTG&A.
Selling, operations, tech, general and admin, those were down $30 million year over year.
Down year over year, even with inflation.
Yeah. And they pointed out that if you combine those SOTG&A expenses with capitalized labor, it's actually their lowest combined spend level since Q2 2019.
2018, before all the pandemic craziness.
Exactly. It's a pretty strong testament to their cost discipline and finding efficiencies.
Okay, so really tightening the belt on overhead while growing the top line and improving variable margins, that's the recipe for leverage.
That's exactly the recipe.
All right, so that was Q2. What are they guiding for Q3?
For the third quarter, they expect revenue growth to continue, guiding for low to mid-single-digit growth year over year.
And that still includes the drag from leaving Germany.
It does. They said that exit would be about a 100 basis point drag or 1 percentage point. So underlying growth is, again, a bit stronger.
Okay.
Margins.
Gross margin guided to the lower end of their 30-31% range. They mentioned being data-driven here. Sometimes they'll pocket efficiency gains. Other times they might reinvest tactically in price or customer experience.
Makes sense. Keep it flexible. Advertising.
Expected to stay roughly in that 11-12% range, similar to Q2. And SOTG&A overhead costs are projected to be stable.
So putting it all together, what's the adjusted EBITDA margin outlook for Q3?
They're forecasting it in the 5-6% range. Still solid, though slightly down from Q2's peak.
Okay. Now, let's step back and look at the bigger picture for investors. How does this all fit together? Wayfair stock has done really well recently.
It really has. It's dramatically outperformed the broader consumer discretionary sector ETF, the XLY, over the last month, 3 months, even the last year. The market is clearly buying into this turnaround story. But what about the overall market for furniture and home goods? Is that booming?
Not really, no. Management themselves described the U.S. home furnishings market as kind of bumping along the bottom, basically flat, maybe down low single digits. It's still pretty soft overall.
So if the market is soft, but Wayfair is growing and taking share.
That suggests their strength is structural, not just riding a market wave. They seem to be genuinely outgrowing their peers and grabbing share from what's still a very fragmented industry.
Who are the other winners in this space?
Well, besides Wayfair, you typically hear about Amazon and maybe the off-price players like HomeGoods showing some resilience, but Wayfair is definitely positioning itself as a major consolidator online.
And what about external factors like tariffs? There's been talk.
Yeah, management addressed that. They said their marketplace model gives them some insulation, helps maintain pricing consistency for customers, at least for now. And crucially, they stated very clearly, they did not see any sign of customers pulling forward purchases, buying early because they were worried about future tariff-related price hikes.
Okay, that's interesting. No panic buying.
Apparently not. Looking ahead, key things for investors to watch would be the full rollout of that loyalty program in October.
See how that impacts Q4.
Right. Then, how their logistics network, Castlegate, performs during the peak holiday season in December. That's always a stress test.
Mm-hmm.
And then, maybe looking further out, any decisions around potential EU tariff escalations in early 2026 could be relevant.
And AI. You mentioned the Gen AI features. Is that driving traffic yet?
They touched on that. Traffic from things like ChatGPT or Perplexity is still pretty small, they said, but they're actively working on optimizing how they interact with those platforms.
Because home goods aren't simple commodities.
Exactly. Their view is that their category, being complex and visual, is actually uniquely positioned to benefit from richer AI-driven experiences like visual search, more so than maybe simpler product categories.
Interesting angle. Okay, so a lot going on. All right, this is the deep dive. And as you know, we like to wrap up with our outrageous but plausible trade idea. Disclaimer. This is absolutely not financial advice, just a thought experiment.
Got the disclaimer in. Okay, what's the idea?
So, given everything we've discussed, the strong execution, the cash flow, and especially that strategic pivot with the expanding Castlegate 3PL service.
Right, the multi-channel logistics play.
Imagine that 3PL business really takes off. Castlegate multi-channel scales up, becomes a major logistics provider for bulky goods, not just for Wayfair's own site, but for lots of other sellers.
Okay, so that becomes a significant high-margin business line in its own right.
Exactly. And remember, they have that $1.8 billion in liquidity. They're playing offense, maybe looking at M&A.
Where are you going with this?
So the core idea is you could establish a long position in Wayfair equity itself, betting on the continued share gains, margin expansion from the core retail business, and this growing 3PL segment. Standard bullish thesis.
Okay, but that's not very outrageous.
Here's the twist. To really amplify that logistics bet, you could also consider a speculative long position in a much smaller, maybe even microcap innovative logistics technology company.
What kind of tech company?
One that specializes specifically in, say, last mile delivery solutions for large, fragile goods. Think advanced routing software, specialized handling tech, maybe even unique vehicle designs for bulky items.
I see. The logic being.
The logic is, as Wayfair aggressively builds out its multi-channel 3PL network, they'll want to make it as efficient and sophisticated as possible, especially that tricky, expensive last mile.
Right, densify the network, offer better service levels.
So they might look to acquire or partner deeply with a specialist tech company that has cracked some part of that complex last mile puzzle for bulky goods.
And owning shares in both Wayfair and a potential acquisition target could offer exponential upside if that happens.
That's the outrageous but plausible thought. It's a bet not just on Wayfair selling furniture online, but on them potentially redefining the entire logistics landscape for bulky goods by leveraging technology, possibly through acquisition.
It's definitely thinking a few steps ahead. A layered bet on both execution and strategic M&A in the logistics space.
Exactly. Food for thought, anyway.
Okay, that really wraps up our deep dive into Wayfair's Q2 2025 earnings.
Yeah.
I think the takeaway is pretty clear. Wayfair is showing accelerating growth, definitely expanding profitability, being disciplined with capital.
And making some bold moves with technology and that new 3PL offering.
Yeah, lots of moving parts, mostly moving in the right direction based on this quarter.
Well, thank you for joining us for this analysis. We hope this deep dive helped you make a bit more sense of the market and Wayfair's latest results. And just a reminder, of course, this discussion was for informational purposes only. It is definitely not financial advice.
We would love to hear your thoughts, though. What stood out to you from Wayfair's quarter? Send us your questions, your insights. And please join us next time for another earnings call breakdown right here on The Deep Dive.